Hey, folks, thanks so much for tuning in today. I know that everybody's busy sheltering in place. We all spend our day thinking about what we're going to make for dinner. It's about the most exciting thing every day. But the Barometer team's been very hard at work, working our way through current market. What I thought maybe we could do today is start out with Jim Shatakis, who is one of our senior portfolio managers, focuses primarily on US equities. Talk a little bit about current economic conditions. And of course, we're in the earnings period. And not that the earnings per se that are coming out right now are the most important thing, but some of the things that we're looking for to try and get a tell as to where things are going. As we talked about in the last webcast, we sort of entered the sorting phase after the first initial rally. A market has to figure out which companies and sectors and themes have a tailwind, which ones are most challenged, to try and make sure that we are positioned in the right spot. So with that, I want to hand it over to Jim, who's the only lonely person sitting in the Barometer office. So I'm just going to unmute Jim. There you go.
Okay.
Oh, hold on. There you go.
Okay. Thanks, Dave. And it's kind of eerie being in the office all by yourself. The whole floor is empty. I think there are 5 people in the whole building, but nevertheless, we're soldiering on. Just in terms of economic activity, I think the main thing I can tell you is that what the numbers that you're going to see are going to be large on the downside. However, once we enter into the recovery phase, they're going to be large on the upside. So what do I mean by that? I'm sure everyone has seen some of the job losses were in the millions, unprecedented numbers. Well, when we start restarting the economy, and make no mistake, the U.S. is going to do it state by state, slowly, carefully, but they're going to do it. And the numbers will be equally large. So don't be impressed by the magnitude. It's the direction that's going to be important. And we're going to see it, whether it's employment, industrial production, trade, all of the above. And that's coming through. The other numbers that are equally large, if not larger, are the responses that the government's made to the crisis, both in terms of spending power and in terms of easing monetary conditions. And in the U.S., it totals up to between $4 and $5 trillion of extra spending and easing of monetary conditions. And that's going to businesses, individuals, across the board, and invariably, and to states. Because what's going on is that the states aren't getting any tax revenue. And the only entity in the U.S. that can run a deficit is the federal government. And they're going to do that quite a bit. So we're in this phase of the government knows the economics are challenged, but they're going at it full blast, very aggressively, more aggressively than we've ever seen actually, we've never seen this in history. It's unprecedented, the aggressive nature of the stimulus programs. So what we're watching for is to see how we recover, what companies are in great shape for a recovery, who's doing well right now, and who has a business plan that and a business model that can get them through this. Because the government programs are designed to preserve the payment system so that individuals, companies can pay each other, and that the the oil that greases the machinery of the economy continues to flow. Beyond that, we'll have to see which companies can thrive in this kind of new type of environment. So think of companies like Amazon, who this crisis was built for Amazon. They're delivering packages, even here, daily. So they continue to do well. Think Costco, think Walmart, who are open. Some of the drug companies, Regeneron, Eli Lilly. Think of some of the companies that also have business models that are bulletproof, like Lockheed Martin, that are a large defense contractor in the U.S. So those are we're looking for what's going on is that the market is bifurcating into the haves and the have-nots. And we're concentrating our portfolios in the haves, in the companies that are not only surviving this, but thriving in this kind of environment. Lockheed Martin reported earnings recently, and they increased dividend and reiterated guidance. The same with NextEra, one of our utilities that's based in Florida. Reiterated guidance, did better than expectations on earnings. So, and we've avoided companies that have challenged models. Think of airlines. Think of the cruise lines, travel, hotels, all challenged businesses. They are going to come back as well, but how they're going to come back, at what profitability levels. Even when people start flying again, the airlines might not be able to sell that middle seat anymore, or it might be a long time before they sell that middle seat. So those are the kinds of issues that we're exploring all the way through. And when we're looking at our portfolios, your portfolios really, and how best to position them going forward. That's Dave, great. If I left anything out, or because I can go on forever,
Well, just quickly, Jim, maybe you could just touch on, we know that these earnings that we're going through are not so meaningful, but really it's sort of the color and guidance that are coming out. So are you finding that the conference calls are very useful in getting color as to where the challenges may be, and in some cases finding challenges maybe we hadn't thought about?
Definitely. Because managements know their business best, and that's the time and place that they can communicate these concerns to us, and particularly their thoughts around the use of capital, whether they're increasing dividend, keeping dividend the same, or eliminating it. What they're doing with shareholder buybacks, what their business continuity plans are. So that's the most meaningful part of the conference call for us. Okay. And we're, as I mentioned earlier, we're trying to concentrate in companies that have thought about these things and have business models that are bulletproof.
It's interesting, Jim. We really can see them separating in the market. Maybe what I can do is just quickly take a run through what we're getting as market signaling or signaling back from the market as to where money is going. We spend a lot of time trying to understand the fundamental backdrop, but more important, understanding how the market's reacting to it. And so I thought maybe I could just jump through a few quick slides and touch on that. Just to put it in context, and for our new friends from Roundtable Partners, our strategy is all about doing three basic things. One is sort of identifying those market leadership themes, sectors, structurally advantaged businesses that have an ability to thrive in the current backdrop, and focus in those areas. We look really very much unlike the market, and very targeted. We've spent a lot of time seeing if there is new leadership sort of emerging out of this environment. And of course, there's some places we have to play some defense And certainly the month of March was a great example of that. The top-down work that we're doing is telling us a lot about which neighborhoods to focus in and which ones to avoid. The bottom-up work that we're doing is aimed at finding securities that are best suited within those groups, sort of the current environment. And thank goodness for the third piece, the selling strategy, because the stop losses saved us a pile of money in March, wound up giving us a pretty good cash weight so that we could get through the sell-off in good shape. We're really focused right now on trying to find groups that have become underowned, where we're seeing expanding breadth, meaning there's a rising cohort of companies within a sector or theme that are participating to the upside. And as long as that breadth is expanding and more companies doing well, that is healthy. And at the same time, looking hard for groups where there is deterioration, where maybe there's one or two great companies, but the rest are weak, and it's hiding some sort of rot underneath the surface. And of course, having a willingness to hold some cash. So in the last call we talked about this waterfall decline, which was really quite dramatic, about 31% over 20 days, and how it was the sharpest decline in history. And, you know, we worked hard going through that period in our various pools. In blue is our strategy versus various benchmarks, you know, to make sure that we didn't dig ourselves too big a hole. And so that is one phase of the process that we had to manage. Second, we said we want to try and maintain relatively low volatility versus benchmark. And this is our income strategy versus, in orange, the S&P. And you can see, and this is back sort of 2010, but just all the periods where volatility spiked, you know, you can see that we've been pretty focused over time at maintaining much lower volatility than the market. Certainly this most recent spike in volatility was a good test, and we were happy kind of to get through that with much lower vol. Now, in the last call, we compared to what happened in the 87 crash, and it was a similar magnitude, a very speedy decline, about the same length of time, a little bit longer actually, if you start from the high point in the market. And what happened coming out of the 87 crash, we were highlighting, was there was a period of sorting that went on where the market really tried to figure out where it was going to go, how much damage had been created, how much lasting damage, which sectors might participate, which ones might fail. But ultimately, the market, after a couple of months in a sharp economic slowdown, reversed and started heading higher. So one of the important metrics is that everyone's looking at the economic data and saying, well, it's slowing, and certainly it's been the fastest slowdown sort of in 100 years. But it's important also to know that on average, if you look back through all the cycles since the turn of the century, the 19th century, the market tends to bottom 4 to 5 months prior to the bottom in economic data or PMI data. So if we believe that it's possible you got the initial bottom on March the 23rd, it's looking forward and saying, well, maybe the economic data bottoms in July or August. Doesn't say it's going to get better, a lot better from there right away. It will get better. On average, if you went back through all the major declines and recessions back to 1900, it takes about twice as long for earnings to come back as it did for them to fall. So it's going to be a process. And when people say, well, it might be the end of 2021 before earnings are back to prior levels, that well could be the case. There may be well demand, or there may be ability to supply in certain industries, but it's going to take time for businesses and industries to re-optimize. And certainly in the case of 87, it was 2 years to get back to the prior high. And that could be the case. It could be that because it happened so quickly, and because the government and the central banks came in with such significant stimulus, way faster than at any time in history, and with way more magnitude, that there will be enough stimulus that as things start to get better, it accelerates things, but that remains to be seen. So we know, based on the last call we did, that every one of the major sort of declines going back over time, and I had 2 tables, this is all of the waterfall declines back to 1929. In each case, there was a sharp rally that came immediately afterwards, and then there was a period of retesting, and in each case, there was a retest, maybe not going back to the lows. In some cases, did go back to the lows and went lower. but where the market did some sorting. And so we look at this phase as there was a major decline in panic. There was a major policy response. We've seen improvement in the health data, but now we need to start to see how long it's going to take various companies and industries to get back on their feet. And so now that we're into earnings, we're going to have some sloppy data come out. We're going to have some bad news days. We're going to have bad days like yesterday where the oil price cratered and scared people, and the market's going to go through some testing. Now we look through our lens, and this picture on the screen is a picture of our breadth model or market risk model that we use, and we're looking at the NYSE here. And this is a percentage reading from 0 to 100. So I said earlier, a healthy market is when more and more companies are participating in a rally, or the buying is spreading to more and more securities. We know that at the market low on the 23rd, only 6% of all the stocks on the NYSE had maintained an upward price trend or had been able to buck the trend. 6%. And that's an extreme number. I've got this data back to 1954. And this is the second lowest reading in history. What that means is everything sold off, starting with the things closest to the problem and eventually getting to almost everything, whether it had anything to do with the problem or not. So even the most defensive business models got hit in the end. Now, you have to go back to 2009 to have had a reading somewhere in this neighborhood. So look what happened in 2009. In October of 2008, after the first 38% decline, the market rallied from October through until the beginning of January, whereby then 64% of stocks were headed higher in an uptrends. So that was a first recovery. But then what happened? The market rolled over and stocks sold off. Now, interestingly, in the second sell-off in January, February, and March, actually many industries did not participate in that second sell-off. But the financials, which were a big part of the market, got crushed because it was a financial crisis. And breadth went all the way back down toward lows. So if we look at where we are today, we bottomed in March. Breadth had a tremendous thrust. We got to the point where 66% of stocks are in uptrends. And then last week, some sectors started to pull back again. So financials, industrials, things that are more economically sensitive, because now we're beyond some stimulus and now we're into earnings, and we're going to find out if there are some insolvencies. We're going to find out if some companies don't have enough cash to get to the other side. And this causes us, as we said last week, to get a little more defensive because we think that there is going to be some sorting to take place. So in a couple of our strategies, we added hedges. In a couple of the strategies, we raised a bit of cash. I said before, we have some fixed income and things that we kept back as dry powder, because if we were to see a pullback from here, there will be some things that hang in really, really well, which will show how strong they are. And there's some things that will give a bunch of the return back because they rallied just on short covering. Okay, so just as a way, by way of looking at history, 1962, an initial low, a 14% rally, an 11% decline, retest lows, and then onward and up from there. 1970, low, 13% rally, 9% decline, onward and upward. You can see each of these market bottoms. 1974, similar, 21%, 14% pullback. 1982, very small pullback, only 5%. 1987, we've talked about. 1990, low, 13% rally, 7% retest, and onward and upward. 2002, that's after the tech wreck, rally, pullback, and onward and upward. And of course, 2009, which we talked about, October, March, and then there was a pullback as we got into later in 2009. So we're looking for clues. And here's what I can point out. The US has been the strongest off the bottom. If we look at other parts of the world, Asia Pacific markets rallied right up underneath the level that they bottomed at in 2018, December. And they've started to run into some difficulty. Europe sold off, bounced back to where they were bottom in 2018. Same thing, the rest of the world, ex the US. If we take the global Dow, so this is the largest companies in the world, sell off, rallies back towards the lows from 2018, has run into a little bit of difficulty. And if we take a broader universe than the S&P 500, which of course is the 500 largest stocks, the NYSE composite is all stocks that trade on the NYSE, bottomed, rallied underneath the low from 2018. So that tells you what the average stock is doing around the world. And we don't want to own the average stock. We don't want to own entire markets. We want to own structural themes that are benefiting in the environment that we're in. So the S&P 500 declined. It rallied about 50% of its initial decline, and over the last couple of days ran into a little bit of headwind. Our point and figure work, which is a type of chart we use to recognize change after making higher highs and higher lows. S&P pulled back yesterday and showed us some technical damage. Volatility, which had spiked at the low, has been pulling back steadily, meaning the markets are becoming more normalized, but over the last few days, a little more volatility. So this causes us just to be a little more cautious. Remember, we said last week, we want to remain flexible. If we work higher from here, we've got great positions, but we do have some cash. It's more likely that we have a little bit of choppiness in the market over the next few weeks as the news unfolds, but we have to remain flexible. We have to remember that half of the equation is managing volatility, not just shooting for all the return we can get. And right now, I think managing volatility probably is most important. So of all the neighborhoods within the market, the strongest off the low has been the NASDAQ 100, the large cap growth stocks. So this just shows sort of a 60-minute chart from the end of March through where we are today on the 22nd. Let's pull the lens back. Okay, themes that are winning. This line at the bottom of the chart is how something is doing relative to the S&P. If it's a rising line, it means outperforming. So this is technology as a whole. Maintained an upward bias, pulled right back to the long-term trend. It's had a sharp rally off it, actually rallied about 75% of the decline. Within that same camp, large-sized growth company. This is the Russell 200 Growth Index. Growth stocks as a whole, way outperforming the market. Now, growth stocks in general have a business model that is not so cyclical. It's more predictable. They have structural growth within their industries, and as a result, less concern about the ups and downs of the economy. Let's go into under the covers to see some of these names. Microsoft, which is a big holding for us, obviously dominant in cloud computing, dominant in subscription-based software, dominant in enterprise software, very resilient because they get paid based on a subscription model, trading virtually back to new all-time highs, a relative strength new high for the market. Adobe is the dominant company supplying software into the digital marketing space. So if there's one thing companies are doing, they're spending money to try and do business in the online world. Relative new strength, relative new high, virtually back to new highs. In the retail space, lots of retailers having a real tough time. Jim made reference to Amazon. Just recently made a new all-time high. Will report earnings this week. Looks very, very strong. Walmart. So one of the things that has come out of this is this market appears that the economy is turning into a winner-take-all economy, where companies that have built business models that are resilient and dominant are taking market share from the rest. There are some who would think that online retail has moved ahead by as much as 3 years in the fight with bricks and mortar going through this process, because people's habits will not change when they come out of this difficulty. Their built-in habits of ordering things online. Healthcare, virtually back to new highs as a whole. Companies like Abbott Labs, big holdings of ours, with of course their dominant businesses. Of course, they're also there in the testing process, which is going to be a big business for them. In the utilities, Jim mentioned NextEra, which is the dominant company in solar and wind. Fortis, which is known for such a resilient business model and dividend growth for years and years. Now, of course, other areas of defensive positioning, the gold sector has been participating and performing remarkably well. With over $5 trillion of central bank stimulus, money printing being pushed into the system, there are many who believe they want to own harder assets, things that might be more resilient than paper currency. And so physical gold itself has been performing well, and the underlying gold producers like Newmont, Franco-Nevada, Barrick Gold, and we have a few other positions in the space. All of these things fairly defensive against a world that has slowed down. In the REIT space, while people may not want to pay office rents and retail rents, they will pay rent on cell towers, which is what American Tower owns. And certainly use of data going up, making a new relative strength high versus the market. And then there's the have-nots that Jim referenced. Things that we have no exposure to, like, for instance, energy. Very little exposure to banks. If this was going to go on for longer than people expect, and there were solvency issues, then the banks can be impacted, whether that's mortgages, whether that's corporate loans, especially maybe in the energy space. This group is, again, much better positioned today than it was in 2008, but we'll take the signal from the market. Relative underperformance has not started to turn yet. Then, of course, there's the industrials. And within industrials, certainly aerospace, the defense sector is performing much better, but transports have been relatively weak. And machinery has been relatively weak. A lot of machinery companies supplying into the oil and gas industry. So we really think that we're in a pretty decent spot. We do think that ultimately we remain in a secular bull market, but we are open-minded to other alternatives. We are open-minded if the slowdown goes on longer than expected, then there are going to be industries and companies that run into real difficulty. The longer it goes on, the more difficult it will be for consumers. So we're very cautious in the consumer space. And we're very willing to get more defensive should the situation change. But as it stands, I think we're in a testing phase. NASDAQ clearly is the strongest part of the market, getting very close to back to flat for the year. And the portfolios as we sit look very unlike the market. They are very flexible. We got lots of cash. We are going to watch over the next couple of weeks for if we go through a little bit more sloppiness in the market, what is it that holds up and what is it that gives it back? And ultimately, we're looking to continue to add to areas of strength in the market, but we want to see this unfold, and there is no rush based on the historical context. So the last thing I want to touch on is this. When markets have their biggest declines, it's when people are out over their skis, overly positioned, and on the wrong side of the market. Current positioning actually is supportive of a better market. So on the screen is short interest as a percentage of the float in the SPDR, which is the ETF that owns the S&P 500. So you can see there is the largest short position in the market that we've had in many years. Ultimately, as things get better, those people are forced to cover. If we look at futures positioning, the number of people who own the market via futures contracts, again, positioning is very, very low. So I think that expectations are low. I think sentiment is cautious. I think positioning is cautious. I think that central banks and governments are showing they're willing to go much further than they've ever gone before to try and make sure that the payment system continues to operate. A question I had over the course of the week is, are we in a recession or a depression? The depression happened in the 1930s because governments and authorities said we're going to give it a laissez-faire attitude. We are going to do nothing to support the market and let it sort itself out. That's what ultimately caused the depression. We are in the opposite of that now. If there is a risk, it's that the other side winds up becoming somewhat inflationary, and that you have a very sharp snapback once things start. So we'll see. As it stands right now, secular growth is the leadership. There's a few sectors and companies within those sectors that are showing really strong leadership. And we're just going to continue to walk forward step by step, make decisions day by day. If positions we own start to break down, we will raise more cash. But the market appears to have some resiliency in it, and we'll continue to walk forward. So thanks so much for tuning in.